Broadcasting live from the Business RadioX studios in the Twin Cities, it's time for Minneapolis-St. Paul Business Radio. Now, here's your host.
And hello again, everyone. Welcome to another edition of Minneapolis-St. Paul Business Radio. I'm John Ray, and folks, this is going to be a good one. Kurt Altrichter is with us. Kurt is the president of Ivory Hill. Kurt, welcome.
Thanks for having me on. Appreciate it, John.
Hey, it's a pleasure. Let's talk about you and what you are up to at Ivory Hill. How are you serving folks out there?
So I'm a financial advisor. So I'm a chartered retirement plan specialist. So I specialize in working with entrepreneurs and business owners. I used to say in the Twin Cities, but it's really all over the country now. I got clients all over the place.
Sure.
And whatnot. And so I help them grow and preserve their wealth, and also help them manage, business cash flows and make business decisions as well as that. So like a little bit of business consulting. I'm a fiduciary, in all aspects of stuff. So I, legally obligated, just like a CPA or an attorney, to, do what is in my client's best interest. And really that makes sense because my income is directly tied to how their, money is performing in the markets and whatnot. And I'm fee only, so I only make money by the clients that pay me. No commissions, no insurance type products, that type of stuff, and whatnot. But where I really strive is I want to see business thrive with the entrepreneurs that I work with.
Let's dive deeper into what specifically that means to be fee only, to be a fiduciary, and why that's so important for the client.
Well, I'll tell you from firsthand experience. So the way that things still go on today, at the big wirehouses, and it's not every advisor, so I'm not going to classify everyone over there. But the way that, when I was at UBS that I had an issue with is, we charge a 1% AUM fee or 1.5% AUM fee on the clients. And then, they put them, the investment managers put them in the funds that we receive commissions on. So we'd get like, a 0.5% upfront load charge from every time we moved in and out of mutual funds. And then we'd also charge them a 1% wrapper fee. So really the fees were a lot more than most clients had. And I never thought that was right. On Wall Street, there's a way to make money anywhere you possibly can. And I believe that being a fiduciary is, I don't know if it's really a separator, because I think that's more where the business is going. What that means, if there's any conflicts of interest, I'm required to disclose them. I don't have any conflicts of interest, but if I did, that's what I would have to be. Fee only means there's two ways I make fees, either from an assets under management. So the balance of your account, times 1% or so that's charged nominally, or financial planning fees. Those are a direct check, very crystal clear, transparent when it comes to that. I'm also required, if I do any recommendations for a CPA or estate planning attorney or benefits broker or something like that, I'm required to do due diligence on them. So I have to, when I refer somebody, it can't be, a referral partner that just refers me a lot of business. I learned really early on that I need to find really good professionals to pair my clients up, and they can't just be, a partnership where we pass cash under the table. It's got to be very legit. And I can be disbarred, for not doing what is in my client's best interest. So, usually what's in their best interest is to see them do well, financially, and whatnot. So then I get paid more, they get paid more, and that's usually a pretty good deal. And that's how I partner with clients.
So it sounds like to me, Kurt, that you are giving up the opportunity to probably make more money in the short run working at a bigger firm. We won't call anybody out, but working at a bigger firm that handles things the way you described than what you are doing now. That's what it sounds like to me. You're working for your client's long-term best interest.
Correct. Yeah. So I like to grow with my clients over time. So I'm not trying to build a book of business. I get paid fat checks right now. Mm-hmm. I'm looking more of a long-term. This is a marriage to me. I mean, it's a long-term relationship. My clients end up being my friends, and whatnot. And so there's this really, we both have a vested interest in seeing the client do well. It's not like selling an insurance policy and moving on to the next one and trying to, sell some long-term care and whatnot. That's not how I operate. I actually outsource all that type of stuff because there are opportunities where it makes sense for, certain products like that. But I kind of delegate that to, I got to work with about 3 to 5 insurance professionals for that type of stuff.
Yeah. Well, I can see how you develop a lot of trust with your clients, and they come back to you for anything financial, really, even though that may not be your core expertise, right?
Yeah, and the best client is the one that, runs everything by me. Hey, I'm about to make a big purchase. Hey, I just racked up some credit card debt and need a little bit more money.
Mm-hmm.
Hey, I'm thinking about buying this business, or I'm thinking about making this big purchase, or hey, someone else has something that in my ear. That's the best client. The only thing I haven't heard from clients is, hey, where do I bury the body? I hope I never have to do that one, but I have to deal with that one. But that's the best client in my opinion, because that really, the more information that I have on, how they think, and what they're going through. Because really what I do is I think the core of what I do comes down is to expectations. And in life, I believe that relationships are either made or broken based on expectations. And so I tend to be a little bit cynical when it comes to clients. When I'm showing them a portfolio or something like that, I actually show them, how it operated in 2008, how it operated in the pandemic. Well, how did it look like? And I try to push them, when do I get fired? At what point do I get fired? When can you not sleep at night? How long can you stay like this? That type of stuff. And then I start talking about, the potential of, investment returns and stability and that type of stuff.
Got it. So you and I were chatting a bit before we came on the air, Kurt, about your philosophy about helping folks navigate the ups and downs of the market. And you're a big believer in actively managing downside risk. Talk more about that.
Yeah. So about right around 2018, last time we had that taper tantrum where the market went down 20% and we made all the money back in the first 2 weeks of 2019, I started thinking, because like all the cookie cutter type of economic indicators that you're taught on Series 7, Series 65, well, if everybody know, usually those reports come out, after everything happened. I mean, nothing's really obvious, doesn't really do anything with that. So I spend a lot of time doing a lot, and I'm an economics major by trade, so I tend to dig into things a little bit more than the average person. So I ran into a guy who's been pounding the horn on, downside risk, working on, managing downside risk when we've been in bull market for 10 years. And I was like, who does this guy think he is? And that's got to be the worst space as a fund manager to be in when the market only goes up. And and so when I kind of ran across his name's Michael Guyad, and so he does what he defines as intermarket analysis. It's a branch of technical analysis, looking at charts and kind of the path of money. That's not really what I'm talking about. What I'm talking about is a study of asset class and kind of sector relationships, and like how different things play off each other. Because what I was trying to find at the time was, what are early indicators of volatility? Why do I care about volatility? It's just like a word that gets thrown around. Why do I care about volatility? Volatility is usually associated with down markets. And so what I look for is early indicators of volatility. And there's about 20 indicators that I follow, and it's a rules-based process. To kind of open up the onion, one of Mike's indicators, he's not the only one that I use, is it's the lumber to gold ratio. And so what that means is that, so he's looking at the ratio between lumber and gold. When lumber is outperforming gold, that is an indicator of a healthy housing market. We're building houses, and that's usually associated with a growing economy. We have a red hot housing market. Mm-hmm. Following me so far?
Yeah. That makes sense.
And then when gold is outperforming lumber, that means that people are getting more defensive in the markets. They're moving money into gold. Gold. People say it's a hedge against inflation, that type of stuff. There's really not a lot of correlation, but to that, so that's one indicator. So when gold's outperforming lumber, and that indicator flipped right at the beginning of February before the pandemic.
Oh, wow.
And whatnot. And so, and then, another one of his indicators that I think also makes sense, that's a short-term indicator that I rely on, is utilities to the S&P 500 ratio. So to utilities divided by the S&P 500, when same kind of concept as the lumber to gold, utilities is when utilities is outperforming the overall S&P 500, which it is right now, by the way, that means that equity traders in an intermarket, what's actually going on in the market, are getting a little bit more defensive. They're moving in the equity field and stocks. When you see utilities outperform the S&P 500, that's a defensive play, because what are utilities? Well, that's your, what you pay at your house, your electricity, your water bill,
sure,
that type of stuff. And that means that, people are usually going to pay those bills, and therefore those companies and those stocks that they're invested in are usually going to go up when the overall market, things like tech are going down.
Mm-hmm.
And so that's kind of a short-term indicator. So I have a rules-based process, again, about 20 different indicators that I follow, where I will reduce risk when volatility is likely. And the way I like to explain is the way kind of Mike explains it as well. When it comes to investing, I kind of look at it like I'm a meteorologist. If you're, say you're driving in a car down the highway, I'm not going to be able to tell you, what mile marker you're going to get in a car accident on. But what I can tell you is that conditions are suggesting that maybe you should slow down a little bit, put your antenna up, increase your awareness, put your wipers on, maybe turn the radio down a little bit, because conditions are saying that you might get into a car accident. And so what I found through back testing is by, reducing certain equity exposures, especially like if you like to use leverage, and that's another topic for another time, but you'd want to reduce leverage.
Mm-hmm.
You'd want to reduce your speculative investment, not speculative investment, but high risk investments down to more boring defensive plays, where we still want to stay invested, but we want to be invested in the more safer places. And then eventually the way that my kind of the indicators work is like kind of stoplights. When that third stoplight goes on to red, it's kind of like hey, we're going to move 100% out of the equity market into treasuries. And I have no problem doing that. One very obvious, kind of rules that I learned in college when I first started working in this business, I was interning at a wirehouse at the time. And I remember reading up on this stuff for the interview, actually.
Yeah.
And one of the things I came on was the 200-day moving average of the S&P 500. And so the 200-day moving average of the S&P 500 is the average price of the S&P 500 over the last 200 days. And when the S&P 500 crosses on the below side, if you were to sell, move to cash or treasuries, it's coming on the downside, and then you move back into the S&P 500 on the upside. If you would have done that, you would have never lost a dime in the stock market over the last 30 years. And that really stuck with me.
Wow.
And so that's kind of like my last thing. If fundamentals are out the door, I like to stick to rules and data. It's not Kurt's, opinion or Kurt's gut feeling. If I can't prove it, the way I like to prove an investment move is if I'm going to be sued in the court of law, can I justify my process through it? And that's not because I think I'm going to be sued. That's just the way I look at it in a document. I'm a military guy, so I like to keep things documented and have a process that's easy to follow and easy to explain.
Yeah, that makes sense. So, Kurt, real quick, you mentioned the lumber to gold ratio, but I don't think you mentioned where that ratio stands today. Is it as unfavorable as the utilities to the overall market ratio you mentioned?
So right now, no, actually. And that utilities ratio is more of a short-term signal. What I mean by that is in the terms of weeks. The lumber to gold ratio is more of an intermediate term. So that one usually takes a little bit longer to fall.
Gotcha.
And so that did flip in the summer. This last year, it's been an interesting market. It always is. When gold was outperforming lumber, signaling that, bearish times are upon us. And that flipped and I was a little bit rocky about that one because it flipped because all the producers were buying lumber and hoarding it because they thought there was going to be a huge shortage. And
right.
So that's just one of the things that you kind of have to deal with, a rules-based process. And that's why I reduce equity exposure. I don't completely get out of investments. Because of that, because if you're sitting in a regular aggressive portfolio, and I reduce, 5-10% of your stocks, that's not really going to make a huge difference. I probably won't even make a difference, within 12 months, of me doing that. But, but if that one market, that one correction does happen, then I'm looking really good. And the client's happy because they're less down than, everybody else who likes to compare their investment portfolios to each other.
So would it be fair to say, Kurt, that a big part of your investment philosophy is, or maybe the primary part of your investment philosophy is, as long as I never lose, I'm going to be ahead over the long term? Is that a layman's way to say that?
Yeah. I mean, I like to win by not losing.
Yeah.
By not losing as much. So that's all I'm doing. I'm not guaranteeing anything.
Mm-hmm.
But anything I can promise, for compliance, I can definitely promise the market's going to go down. I can't promise the market's going to go up. So yeah, I look at it by winning by not losing as much. And then the second part of that is when you get back in. And so I have a process for that as well.
Mm-hmm. Got it. Folks, Kurt Altrichter is with us, and Kurt is the president, founder of Ivory Hill. So, Kurt, let's talk about what you see ahead in 2022. And I guess what the markets are up significantly since the pandemic started. What now? I mean, and I know, again, every client's different, so folks consult your own financial advisor or what have you. But so let's just say that. But in general, I mean, what are you looking at?
So we're at a really interesting time right now. The market, year to date, when the S&P is up 20%, it's being held up by about 5 stocks. And whatnot. And if you look at that, I think it's about 7 stocks right now, the big boys, Facebook, Google, NVIDIA, Tesla recently added into it, but all the rest of those stocks are I was reading a chart the other day that said the top 7 stocks in the S&P 500 are responsible for 35% of the investment return, while the other 493 companies are actually underperforming. And that's kind of that's a red. So the activity, I mean, right now, short term, like this week and next week, the activity should be pretty light going in the week of, Christmas. It usually is, which, could favor higher, risk assets or stocks, and whatnot. The market landscape, in my opinion, though, is going to be increasingly difficult to navigate as we get to 2022, as a lot of things have to go right, for stuff to continue to rally. And in my opinion, there's very lofty valuations, including evidence that, I do think inflation is about to either has peaked or is about to peak. Growth remains strong. The central banks are moving, like they always do, which is really slow, to remove the accommodation and raising interest rates. If any of those things were to go wrong, it'll be a source for, broad market volatility. And, having said that, do I think a Santa Claus rally remains possible to year end? I do believe so. But I'm more of looking into 2022, 2023 at this point.
Got it.
We got, 40%. Another thing is like 40% of personal wealth, being accounted for by stocks hasn't been this high since the peak of the tech bubble.
Oh, wow.
If you look at how much, and what that tells me is that there's a lot of overconfidence in the market. People are getting pretty confident with things, or even cocky, to the point where it's probably negligent, in my opinion. There's a lot of leverage in the system. Margin debt versus the S&P 500, every single time margin debt went above 50%, which it did. It has, in the last year or so, and then fell below 50%, there's been a major market correction. We have now gone up and below. Now, I'm not saying that a market can stay overbought for years, and whatnot, but with 1/3 of the S&P 500 stocks trading below the 200-day moving average, and the market trading at higher multiples than before the COVID crash, conditions don't look great for stocks. But that does not mean that they're not going to continue to go, because conditions can change, and the market can stay overbought for years. So, I don't want to be a bear. I get, beat up by some people verbally for being super negative. It's like, no, well, that's my business. I'm focused on that downside risk. I'm hyper focused on that. I'm looking to see what possibly can do that, but that doesn't mean I'm making a lot of moves, and whatnot.
Got it. You're just preparing clients for what may be ahead.
Setting expectations.
Right. And it's important to point out here, folks, as you listen to this show, I mean, we're recording this show here at the end of December 2021. If you're listening to this show into 2022, you better check back with Kurt because things may have changed. So let's put that out there. Let's talk about economic outlook and what you see in the economy and how that affects your investment posture, not just for stocks, but for fixed income investors as well.
Yeah, that's a good one. I mean, fixed income. Let me say this. This is the first time I've ever heard of or even done myself. I tax loss harvest fixed income this year. It means I sold it because it was underperforming here at year end. And I've been selling out of it to tax loss harvest for clients. So fixed income has been going down. And I mean, that's probably the biggest frustration for financial advisors across the board is what do you do with new money?
Yeah.
when equity markets are, aren't sitting on pins and needles, but they're not clear outlook like they were in the last 10 years. And then fixed income is also going negative. That doesn't happen.
Right.
It is happening right now. And so, I mean, economically, I think that the Fed has set the table for 2022 and beyond. Powell and company, Jerome Powell, kind of came out and did exactly what the market had priced in with his, cutting $30 billion a month and whatnot. And I mean, now the consumers face a 7% inflation rate. Producers are faced with 10% producer rate. And Powell is effectively forced to pull the trigger on removing some of this, frankly, absurd, ultra accommodative conditions that he has provided.
Got it. So what do you recommend specifically for retirees that are out there? I mean, that, where they're more, the typical retiree is more oriented toward fixed income. I mean, what are you thinking about that particular class of investor?
I'm glad that you asked that question. Because that's something I'm very passionate about in general. Before fixed income was going down, I've still been passionate about this because, like a lot of people, I had a grandma used to send me birthday cards. She'd send me, a birthday card. I remember I got like $100 bill in the mail. And, when you're, under 10 years old or whatever age I was, it's a huge deal. And you put in a savings account and whatnot. But, over the years though, that $100 went to 50. And then that 50 went to 25, and then that 50 went to 20. And then, eventually I just got a card in the mail. That's because grandma kept all of her money in CDs. And the point of this, it's not that CDs are bad in general, or fixed income is bad in general, but it does not keep up with inflation. And inflation, for the government says inflation is, usually about 2%. There's an interesting study, a guy who created the Chapwood Index where it's not 100% correct with the data, but what he did is he created a huge Facebook group of everybody in major cities about what people actually buy at the grocery store, gas, what kind of type of services they do. And he figured out that inflation is actually more than what it is today. And he said, so in Minnesota here, where I'm based, that Chapwood Index has the inflation of the cost and goods and services that we buy is about 9.86%. When the government says it's 2%. And so I do think that there is a discrepancy between what the government says is inflation and what it actually is, and whatnot. So I think there's a happy medium between the government and, probably, that 10%. When I run financial plans, I run inflation between 4 and 7%. And so you need to have equity exposure. And so a good, a tool that you can use is, real estate, like a REIT. There's a few companies out there that do some really good concentrated REITs, great during the pandemic, that do, no commercial, single family homes, out in the country, or Amazon last mile delivery services, that type of stuff. So it's not really going to go away. Another aspect that you can look at is, boring is going to be good here in the next year. I do think that boring is going to begin. What I mean by that is all this high tech, mid cap type stocks, your Peloton, your Ubers, that type of stuff is going to continue to get hit pretty hard right now. They did well during the pandemic because that was the only place you could really see any growth was technology, because everything else is shut down.
Sure.
So I think boring is going to be good. Where do you want to be with inflation is, things like banks, financials, that type of stuff, precious metals and mining, utilities, healthcare, consumer staples, kind of energy and financials, industrials. I think that, on dips, that's what I've been buying lately, is more that kind of value, boring, not very sexy, but going to be here for the long term companies I think are going to need. I think you're going to we have seen the transition from kind of high growth Facebook, Apple, Google tech back to, some nice value oriented companies that give good dividends. They don't really go up or down, and that will start to continue to outperform. And it has so far this year.
Good words here, folks. Lots to ponder from Kurt Altrichter, and Kurt is the president of Ivory Hill. So, Kurt, I'm curious how someone's heard something here that makes them want to be in touch. Talk about how you work with a new client. What's that process like?
So the process is typically first of all, how you can contact me a number of ways: LinkedIn, Twitter, or you can go to my website, ivoryhill.com, and you can actually schedule a meeting directly on my calendar there, a virtual meeting. So what I like to do is do a virtual meeting, and that's kind of get to know us. Let's see, what your situation is. Some people call it a screening meeting or something like that, but I'm looking for, do I want to work with that person? Is that someone that I can see myself working with over the long term? Mm-hmm. They might have a lot of money and they might want to give it all to me right now. That doesn't mean I want to work with them. I turn away clients, actually constantly, because I want to be happy when someone calls me. I don't want to go, oh, God, John Jones is calling me again because Apple stock went down today. Like, I don't want that phone call.
Right.
But so we'll kind of see, is this something that we see going forward? Then we move to the next step. The next step is just a preliminary kind of data gathering. We'll build out like an asset map, throw everything on a piece of paper, take a look at it, and then kind of poke holes in, where do we see opportunity? What do we not? And then after that, I like, even if they're ready to come in, I like to say, take a couple days and just think about it. I mean, this is a big decision. I believe it is. Take a couple days, sometimes if I don't see it's a good fit, I have no problem. What I like to do is keep a nice, network of other really good financial advisors that I can make referrals to. So the client is still being taken care of by somebody. I'm really just looking at working with good people, business owners that want to, trust the process, see a long-term view, good savers. I don't typically take on clients that have unreasonable expectations. So in that first call, we really talk about expectations, clear and cut. And if they're expecting something that I can't provide, I have no problem telling that. I'm kind of look at it like a doctor. You go into your physician, if your arm hurts, can you fix your arm or not? Or should you really have that done by someone who specializes in that? And so if I don't want to, because I don't want my clients to be too different from each other. And so I won't take on a client if I don't think I can do a good job, or if I can't do the best job for them.
Wow, Kurt, this has been awesome. I mean, great words, and it's been such a pleasure having you on. I know there's some folks out there that would like to be in touch after they've heard you speak about how you do what you do. So let's give them directions. How can folks get in touch if they'd like to have a conversation?
Again, my website, ivoryhill.com, you can go ahead and schedule that, or you can by email. It's kurt@ivoryhill.com. You can send me an email. The phone still works too. So people are more than happy to pick up the phone and give me a call. I know that's kind of weird today. Every meeting I have, I got a camera on, but it's okay to just pick up the phone and call too.
Yeah.
In fact, that's how I operate the best. So, a lot of ways to reach out to me. Go to the website, see what we're about. And then, feel free to just, bounce some things off me. I like being a sounding board for people, because really at the end of the day, what is this profession about? It's about helping people get to where they're going. So, no question is ever stupid.
Yeah, that's great. And just to reiterate, folks, if you missed it earlier, Kurt mentioned it. Yes, he deals with clients in the Twin Cities area, but also all around the country. So you're not confined by geography. Yeah.
And so, pretty much work with anything from your kind of solo entrepreneurs, to retirees. You know, we do a great job in this business of telling people to save more money, but we do a terrible job of telling them actually how to distribute that. So I work with that, as well as, you know, I got entrepreneurs in multiple different angles. I got working with, you know, doctors' offices, that type of stuff, attorneys. I am a fan of unsexy businesses. I got, you know, a client's kid who's, you know, putting up Christmas lights and making $10,000 a week, and he's 20 years old, no college degree. I got a client who's actually an Instagram model, who's, you know, making, that's one of my newer businesses that I can't believe how much money she's bringing in, you know, between 100 and 200,000 a month.
Wow.
That type of stuff. So, I've seen a lot of stuff, and what I'm favorite is if I can get my clients to work together, and too, if I can see synergies between their two businesses and help them build and grow and kind of become blood brothers, you know, through that process. That's my favorite thing to do.
That's awesome. Kurt Altrichter, folks. Wow. What a great time we've had. Again, he's president of Ivory Hill. Kurt, this has been terrific again. Thanks so much for coming on.
Thank you very much, John.
Hey, folks, just a quick reminder, Minneapolis-St. Paul Business Radio is present on all the major podcast apps. You can find us on any of them. We would love it if you're not already subscribed to the show to do so. Subscribe and share the show. If you like the work we're doing here, we would love it if you could let your friends, neighbors, colleagues know. It's not about me or Business RadioX. It's about our great guests like Kurt, who do great work, and we want that work to be found, celebrated, and for folks that might want to use their services to know about them. So if you could help our guest in that regard, we would appreciate it. So for my guest, Kurt Altrichter, I'm John Ray. Join us next time here on Minneapolis-St. Paul Business Radio.